So I've gotten some requests for how to set up QuickBooks Online or QuickBooks in general specifically to handle inventory for a used car dealership. So I'm going to do this walkthrough and basically do the setup for two different scenarios. One where you purchase the car outright, and the second scenario where, let's say, you have a line of credit with some vendor, like let's say an auto auction, and they extend you that line of credit and you use that to get your inventory, and then you have to make payments on your inventory to the vendor and then pay off what you owe to them on the vehicles you purchase once you sell the vehicle. So right now I have the sample company set up. The only real accounts that I have set up so far is an operations checking account that has currently $100,000 in it. So let's go ahead and go through the setup first of all with some of the accounts you're going to need. First of all, we need to set up an inventory account to track the vehicle inventory. So, and again, this is going to be in QuickBooks Online. I recommend, if you're doing this in QuickBooks Online, use QuickBooks Online Plus. That way you have the ability to use the class tracking, which will make everything so much easier for reporting purposes. So the first account we're going to add is we're going to do a other current asset account. For the detail type, it's going to be inventory, and we'll call this flooring inventory. In the automotive industry, a lot of the people use this as called floor planning. That's this method of accounting for the inventory going back and forth. So we'll call this flooring inventory, and this is our asset account. We're going to say June, beginning of this current month, and we're not going to put any starting balance in there. So then we're going to do save and new, so we have that one set up. Now the other kind of account we're going to use is, let's say for one scenario, if you have to carry a debt to your vendor, that they extend you a line of credit. So then for that account, that's going to be an other current liability, and we set that up as a line of credit, and we'll call that flooring debt, because that's the amount you're going to owe for your inventory. Again, we set the starting balance as of June 1st with an unpaid balance of 0. We do save and new. Now the other type of an account that we want to set up would be the account to track the different expenses that your business is going to incur to prep the vehicle to get it ready to be sold. So in one example, let's say it's going to be an expense account, and let's say it is, where is it? Other business expenses. And we'll make this a parent account, and we'll call it vehicle prep. So now if we do another account, let's say it's an expense account, again, other business expenses, let's say we call this cleaning and detailing. We're going to say it's a sub-account of vehicle prep. And now let's say we have another expense account, and that's going to be another business expense, and let's say this is for repairs. It's still going to be a sub-account, and it is for vehicle prep also. Now the other type of an account that we want to set up is, if you have a line of credit with, say, the auction house, as an example, I'm sure they're going to charge you interest on these vehicles that you're purchasing from them. So let's say we're going to create another expense account, because this is an expense to your company. This is just interest, only interest. And it's going to be interest paid. And let's call it flooring interest paid. It's not a sub-account. So now we do save and close. So now if we look at our chart of accounts, we have our main checking account. We have our flooring inventory, which is our asset account. We have flooring debt, which is the money we'll owe to the auction house. We have the flooring interest paid, which is the interest. And then we also have, for vehicle prep, we have the two accounts that we'll use for this example. So now to set up the inventory. So what we would do is we go to, in QuickBooks Online, we go to our products and services. We'll say a new product. It's going to be an inventory item. Now I already set up a couple of samples just for naming conventions. You can name them however you want. This is just an example. So let's say one of them is a Ford Focus. Now for class, again, class tracking makes it so much easier. So for every item, we're going to create a class with that same exact name. The initial quantity on hand is 0. The as of date will be, again, we'll set that as the first. Reorder point, we'll leave that blank. For the inventory asset account, this is going to be that flooring inventory asset account that we created. For the sales information, we can go ahead and again put in the same exact name. You can put in whatever description you want. Sales price, we're going to leave that as it is. For the income account, you can either leave it as sales of product income. I'm going to actually we'll go ahead and leave it as sales of product income because that's the main one we're using. Actually, you know what? Let's do this. We'll come back and change that. I'm going to create a separate account just for the vehicle sales. So for sales tax category, we'll leave that blank right now. We will charge sales tax on it just for this example. For purchasing, again, we're going to use that same exact thing. Cost, we're going to leave blank. For the expense account, we're going to leave that as cost of goods sold. So then if we do save and close, and let's actually go back to the accounting and create a separate account, actually two separate accounts to make this example really kind of stand out. So we're going to create an income account, and we're just going to, it's going to be sales of product type income, and let's call it vehicle sales. And let's do another one here. Income account, sales, or actually we'll call this, yeah, sales of product income. And let's call it warranty income. Let's say you sell an extended warranty with your vehicles. So we save that. Now if we go back to the products and services and we look at this item, and there we go. Let's just change the income account for this to vehicle sales. Okay. So now we have one vehicle there. Let's create another vehicle. So again, do new inventory item. Put that in there. Class, we're going to add a class. Call it the exact same thing.
initial quantity on hand is 0. The as of date is the 1st. Inventory asset. This is our flooring inventory. Sales information will be the exact same. Income account will be vehicle sales. Leave it as taxable. Purchase information, leave that there. Use the cost of goods sold account as the expense account. And we save that, and we'll create another item. This one, we're going to set it as a non-inventory. And let's say 36-month warranty. Creating the class. Paste that there. And let's say we always charge $500 for the warranty. Typical price. And for the income account, this one, we're actually going to use warranty income because we want to track the warranty sales separately. We're not going to charge sales tax on the warranty. And we're not going to, we don't purchase this product from anybody. So we don't need an expense account associated with it. So we do save and close. Okay, so as you can see, we have two vehicles set up here. Ford Focus and a Blazer. Right now we have 0 quantities on hand. They're taxable. So let's jump right into it. Let's say you go to the auction house, and let's say for this one scenario, you purchase the vehicle outright and you don't need to carry any kind of loan against it. So what we would do, we create an expense. And I've already set up a couple of vendors and customers in here. So for the vendor, let's say we're buying it from auction house number 1. And let's say we purchased it that Saturday. Say we paid cash from our main bank account. Now instead of the account, what we do is we look at the item for the product, and let's say we bought the Ford Focus. And we paid $2,500 for it. You see how it automatically put in the class for that same item. And it shows the total expense was $2,500. And now we do save and close. Now, in this type of scenario, one of the reports for tracking these, the best one, in my opinion, if you have class tracking on, is if you go down to, where is it, sales and customers. Oh, sorry. It's profit and loss by class. So if we run that report and we set it to all dates, you'll see there's nothing there so far. Okay? So let's go to, we've purchased the vehicle. Let's say we need to pay somebody to clean it up for us. So we go ahead and pay John's Auto Detailing on that very same day. And we go to the account. And let's say for vehicle prep, or no, I'm sorry. Yeah. Here we go. Vehicle prep, went a little too far. cleaning and detailing. Okay, and let's say he charges us $150. Okay, this is going to be for the Ford Focus. We've incurred $150 for that. Now let's say that we had to pay a mechanic to also do some repairs on it. So we go to the account, we choose vehicle prep and repairs, and let's say we had to shell out $750 for repairs. I mean, this could be whatever you want, body work, etc. For the class, again, we're going to select the vehicle that it was for, in this case the Ford Focus. And we've got $750. So we save and close. So now if you look at the report again, now you can see that we've incurred $900 total expenses for that Ford Focus. So right now our net income is minus $900 because we haven't made anything on it yet. So let's say we've done all the repairs, everything is all set, now it comes time to sell it. Let's say a customer comes in, we're not doing an invoice, they're paying it off completely, so it would be a sales receipt. And let's say Bob Jones decides he really likes this vehicle, he wants to buy it. For the product, we're selecting the Ford Focus, and let's say we sell it for 12 grand. And let's say he also wants an extended warranty with it. So we select the warranty. You'll see it automatically plugs in the $500. It's not taxable. And for the class, actually, for the class on this, instead of the warranty, we'd actually want to still select the vehicle. Forget what I said about the class for the warranty, unless you want to track it that way. If you want to, you can. For our reporting purposes, I like the way it looks if you track that warranty to the vehicle. So then, as you can see, we've got $12,500. It's calculating the tax for the Arizona agency I set up as an example on that. Altogether, $13,544. So we double check the date. That's on the 2nd. And we save and close. Now you can see the report changed. It shows that we sold the vehicle for $12,000. We made $500 on the warranty. And then what it did is it plugged in the cost that we put in for the vehicle, how much we paid from the auction house, which was $2,500. So our gross profit is $10,000. Then it also takes into account the expenses, the cleaning and detailing we put into it, as well as the repairs. So you have your total vehicle prep expenses of $900, total expenses, so it takes your net income for this vehicle down to $9,100. Now also, I wanted to show you that if we look at the, where is it? Here we go, flooring inventory. You can see that our balance in that is 0. But if we look at the register, you can see, close this, you can see that when we started, we had the value of 0. That's when we first created the item. When we purchased the actual item, it actually increased our inventory, flooring inventory asset account by the amount that we paid for that Ford Focus, because now it's part of our inventory. And then when we sold it to Bob, it then decreased the inventory asset account back down to 0 because we no longer have that in our inventory. That's why we have that report. So now let's say we have a situation where it's an auction house that extends us a line of credit. Let's say they give us $50,000 line of credit. And you need to track that as you keep going on. So you would start out with the same type situation, but it would be a little bit different. So if we go to, let's say we're buying it from auction house 2, because they're the ones that extend us the credit, and let's say it was the following weekend on the 9th. Payment method, we can leave that blank. Now for the item details, let's say we bought a Chevy Blazer. And let's say we paid $3,500 for it. You can see it has it in there. Now normally, this would record an expense of money leaving our bank account for $3,500. But remember, they extend us a line of credit. So what we do is, in addition to this line down here on the item, we go to the account section, and we select the flooring debt. We can actually take that same description, paste it in there, and for the debt, what we'll do is enter it as a negative amount. So it'd be minus 3,500. Now when we tab out of that, you can see that the amount is 0 because we're not actually paying anything out of our pocket for this. For the class, you still want to assign that same vehicle class. So we're increasing the debt account. We're increasing our inventory asset. But as you can see, the total is 0 because it's a wash. So let's say we save and close that transaction. And I'll show you how that affects it right here. If we look back at the account chart of accounts, you can see our flooring inventory asset has increased by $3,500, but also our debt account for the flooring line of credit has also increased by $3,500. So let's say that it comes time, we haven't sold the vehicle yet, and we need to make a payment to the auction house on that line of credit. So we record an expense. It would be to the auction house for that. And let's say it was the following week. You can do this on whatever schedule, that doesn't matter. It's however the terms are that you set up with your vendor. For the account, we're going to select the flooring debt account, and we can paste that same description here because it's for the Blazer. The amount, let's say $300. And for the class, we're going to go ahead and select that same vehicle. Now also, they're charging us interest. So then we actually have to pay them interest. And let's say they charged us $50 interest. Still that same class. So altogether, we made a payment to them for $350. 50 of that was interest. 300 was the amount that we already owed them through the line of credit. Go ahead and do save and close. And now if we go back and look at the report again, you can see how this changes. If we look at the profit and loss by class, you can see now we have the Chevy Blazer. Right now we don't have any income on it because we haven't sold it or the warranty. The cost of goods sold is 0 because right now we're running the report in an accrual method. The expenses, you can see how we have $50 worth of expenses here. Vehicle prep, we haven't entered any expenses yet. So right now, we have only incurred $50. Now keep in mind though, again, this is an accrual method. If you run your business on a cash basis, if you just switch the report to cash and then rerun it, you can actually see now that even though we haven't sold the vehicle yet, it still shows that our cost of goods sold is $3,500 because we have paid that money to acquire it. So then it does affect that, and it shows that the total net income isn't just the $50 expense, but the total of the cost of the vehicle as well as the interest paid on it so far. So we'll go ahead and just leave that report like that. Now comes time, again, we need to do some prep work on the vehicle to get it ready to be sold. So we go to expense, and let's say everything is still done that same weekend. We bring in John to do some detailing. You can plug in that same exact, let's say that's a standard rate, 150. But remember, it still has the Ford Focus here. Depending on how you have your QuickBooks set up, it might be remembering some of these entries from the last transactions. You definitely want to pay attention to that because you don't want to be associating it with the wrong vehicle, the wrong class. So this one is actually for the Blazer. And so we save a new. And now we got to pay Mike. Let's say this one needed an engine tune-up. And that's a lot less expensive. Let's say he only charged us $300 for that one. Again, we want to make sure we have the right class selected. 300. We close that. Okay. So again, if we're looking at the report, right now it's an accrual. We haven't sold it yet, so our cost of goods is 0. We have the interest we paid on it, which is 50, the vehicle prep work. So we're doing better. Now we've only lost 500 on it. But again, if we run it in cash mode, technically we're $4,000 in the hole on it. So let's say that very same weekend, somebody comes in after the work is done, they decide to buy it. Again, we do a sales receipt, and let's say we sold this to John Smith. For the item, he bought the Blazer, and let's say we got a really good deal on this. Let's say he bought this for $17,500. We're going to calculate tax on it, make sure that the right class is associated, which it is. And let's say he did not want a warranty. He just wants to buy the vehicle. That's fine. So altogether with tax, we're collecting $19,022.50. You can see it calculated the tax right here. Balance due, 0. They're paying it completely off. And we save it. Now, if you look at the report, whether it be cash or accrual, it's not going to make a difference because we've already incurred all the expenses and collected all the money we're going to for it. But now you can see we've got $17,500 income on it. Our cost of goods to purchase the vehicle was $3,500. That gives us a gross profit of $14,000. We did have to pay interest on it. Now, it's not the amount that we paid to them on the line of credit. This is only on the interest because that's an actual expense to our company because our vendor has to make some money on it as well. So we shelled out $50 for interest the whole time we had that vehicle. Here's our fees for the vehicle prep. And then here's how much we actually made on it, $13,500. So altogether, when you run this profit and loss by class report, it'll show you the different vehicles. And then, of course, you can always come up here and customize it if you want to look for a specific class or AKA vehicle. You can do that. In desktop, it's going to give you more options for reporting. This is just the basic thing. And then, of course, also, you can see how it's keeping track of everything for you. Obviously, in our checking account, it's increased because it shows that we purchased the vehicles, but then at the same time, we incurred expenses, and then we have the sales of said vehicles here. If you look at our inventory asset account, our flooring inventory, it's back down to 0 because you can see that we purchased the Blazer, but then we sold it. Now also, what you have to do is remember that right now you still have that $3,200 debt. So after you sell the vehicle, let's say, hey, we need to pay them back for that vehicle to open up that availability of credit again. So at that point, you would just create another expense. This would be to auction house 2, flooring debt, and it was what? It was $3,200. Is that what it was? Counting. Yes, $3,200. That's still what we owe on the debt. So then we do another expense. Auction house 2, flooring debt. This is actually going to be $3,200. It's going to be for the Chevy Blazer. And we don't need this line for interest because we're just paying off our balance on it. So we remove that. $3,200 coming out of our operating account. Save and close. And now you can see that our flooring debt is down to 0 again. And if we run our report, again, profit and loss by class, you can still see that our net income on that Blazer didn't change because all we're doing is paying off the amount of credit that they extended us. So now we're back to 0 with them, and we have the full amount of credit available to us to purchase vehicles. So those are the two most common examples that I've been asked about. If you have any other questions, feel free to go ahead and reach out to me. And again, this is one of the most useful, for this type of situation, this is one of the most useful reports that you can find in QuickBooks Online. I'm sure desktop has the same type of report or equivalent. It might be called something a little bit different. But basically a report that shows your profit and loss broken up by class. And then of course, if you just want to run a regular profit and loss for your business, where it doesn't divide it up by class, you can see it takes the totals of everything. You've got your vehicle sales, your warranty income, your total that you've shelled out, the expenses you've incurred, and your net income for everything. So thanks so much for your time. And again, if you have any questions, don't hesitate to reach out. Thank you.